Hello and welcome to Inside India. I'm JP Ong and here are your headlines. More details starting to emerge on the U.S.-India trade deal, with India giving the United States limited access to agricultural products. But tariffs on other goods were lowered to zero. U.S. Trade Representative Jameson Greer outlining that in an interview with CNBC.
India, like every country in the world, including the United States, has some protection around some certain key areas. Well, they'll continue to control that, and we'll continue to work on access. But for a variety of things, tree nuts, wine, spirits, fruits, vegetables, etc., they're going down to zero.
Indian markets will be looking to build on Tuesday's gains, but broader tech pressure may keep a lid on that sentiment. And gold prices are rebounding above $5,000 after their best day since 2008. Goldman Sachs is saying there's still more room to run. Billion investor Ray Dalio telling CNBC that the precious metal is still the safest bet.
Gold is the safest money in this kind of an environment.
Still the safest.
Yeah, it doesn't change. It's a very effective diversifier to other parts of the portfolio.
Good morning and happy hump day. We take a look at how Asian markets are faring at the midweek session. And this Wednesday morning looks like most major indices trading mixed to the upside today, and a bit more reason to smile for major markets. You see here the South Korean Kospi finding itself comfortably above that 5,000 level once again after early pressures we saw late last week and early this week. They are looking like they've regained some of their confidence, but again, tech shares are weighing on certain offers like on the Nikkei 225 in Tokyo, which is down by 0.6%. Similar for the tech stocks out in Hong Kong, the Hang Seng now being pulled down by about 0.5% today's session. Meanwhile, just a little bit of defiance, a little bit of resilience, that is, for the Taiwanese TAIEX. Despite opening today in the red, we find the Taipei benchmark now rebounding and holding on to those slender and modest gains. More details now emerging out of the trade agreement that India and the United States struck, bringing down tariffs on Indian goods to 18% from 50%. India's Commerce Minister Piyush Goyal saying that the two countries will sign the deal soon once more technical things are finalized. There were questions around if India has still protected its sensitive sectors that reportedly prolonged the negotiating period. The Commerce Minister answering that part in a press conference just last evening.
U.S. trade deal maybe.
In the U.S. trade deal as well, India's sensitive sectors such as agriculture and the dairy sector have been protected.
Meanwhile, our colleague stateside spoke to the U.S. Trade Representative Jameson Greer about this deal. Greer is saying India indeed protected some of their agricultural goods, but the tariffs will go down to zero for most of the U.S. exports to New Delhi in that particular sector. Take a listen to what he had to say.
So with India, right now, today, for industrial goods, their average tariff is about 13.5%. That's going to go to zero for virtually everything. When I say virtually, I mean 98, 99%. On the agricultural side, there's a vast array of agricultural goods that will go to zero. India, like every country in the world, including the United States, has some protection around some certain key areas. Well, they'll continue to control that, and we'll continue to work on access. But for a variety of things, tree nuts, wine, spirits, fruits, vegetables, etc., they're going down to zero.
But
so this is a big win.
And you got the oil concession, which it just seems like a lot of things. The non-trade barriers are being significantly reduced by India as well.
Yes, the non-tariff barriers, as you know, Joe, if you get rid of a tariff, that's one thing, but often the non-tariff barriers pose problems. So we have an understanding and agreement with the Indians as well on a variety of technical barriers to trade, areas where they have not accepted U.S. standards. We know American goods are safe. We know they're effective, et cetera. We have effective regulation in the U.S., sometimes too effective. So we have an agreement with them on a process for recognizing certain U.S. standards. They obviously have their own political considerations and they have their own processes for accepting those standards, but that's a key portion of this trade agreement that should open up this market of over 1 billion people to U.S. goods.
How much are we talking about in terms of displacing Russian oil for use by India? How does that work exactly? And some of it could be Venezuelan that they would get from us, some of the 50 million barrels that the president talks about all the time?
That's right. So remember, India, prior to 2022, 2023, really didn't import Russian crude.
Right.
They took advantage of a situation where Russian crude was trading at a discount because they couldn't get it to any other countries because of sanctions. President Trump very accurately put the Indians on notice that we viewed this as supporting the Russian war effort. And starting early, at the end of last year, the Indians started winding down their purchase of Russian oil. We've been monitoring that. They've been diversifying purchases of energy from the U.S., not just oil, but also gas, propane, other things. That's been going up. We'll keep monitoring that. Obviously, they want to diversify from other sources too, whether it's Venezuela or the Gulf, et cetera. There are a lot of opportunities to do this. The Indians are making the right choice.
And also more engagements between the two sides. Continuing, Indian Foreign Minister S. Jaishankar is in Washington, D.C., and he met with U.S. Secretary of State Marco Rubio there, discussing critical minerals, energy, and trade. Reportedly, Jaishankar will also participate in the Critical Minerals Ministerial meeting, which will be convened by Rubio. While in the United States, the Indian Foreign Minister also met U.S. Treasury Secretary Scott Bessent, discussing advancement of a strategic cooperation between Washington, D.C. and New Delhi. Meantime, Bloomberg is reporting that Google's parent Alphabet is planning a major expansion in India. The report says Google is leasing one office tower and securing options on two more in that, together totaling about 2.4 million square feet. This will be in the southern tech hub of Bengaluru. If fully occupied, the space could house up to 20,000 additional employees, potentially more than doubling Alphabet's workforce in India, which currently stands at about 14,000. Google has already pledged billions into building a data center in the country. The move comes as tighter U.S. immigration rules, including a steep hike in H-1B visa fees, are encouraging American tech firms to shift more critical work out to India. Well, the Indian markets are set to come online in just under 40 minutes. And here's what Gift Nifty futures are now flashing today. We are seeing that compared to yesterday's close, we're just looking at a possible modest gain flat to the upside right now at 25,784, indicating that there's still some caution with regards to where markets might head. Keep in mind, it's been a fairly busy last couple of days. We had the Indian budget earlier this week and also the announcement of that true U.S.-India trade deal that I'm sure investors out in Mumbai and across the world are still trying to digest. We have the Indian rupee today just softening against the dollar now at 90.41. Mind you that the record lowest for the Indian rupee, or the weakest on record, is at 92 against the U.S. dollar. So we'll see if they decide to test that in the coming sessions. Meanwhile, to help us digest all that's happened over the busy last couple of days in Indian markets, we have Nitin Jain, who is the CEO and principal fund manager at Kotak Mahindra Asset Management here in Singapore. Nitin, thank you so much for joining us today. As we mentioned, very, very busy last couple of days. I'm sure you've had your eyes glued to the screens, whether it be budget or the trade deal. But I have to start with the trade deal here, of course. What does this do for market confidence from investors, especially after months of foreign funds staying on the sidelines in India and also the rupee at record weakness? There's been a lot of talk about there being uncertainty with regards to the Indian markets. Has this given the markets enough certainty, or is perhaps more needed, despite the fact that we've seen a promise to lower those tariffs?
Morning, JP. Yeah, it's been a very eventful last few days. Don't forget, we also signed the EU FTA, and that's on top of, then we have this budget and the big deal with the US. I think there is a lot more required to get global confidence. These are important steps. These are very, very important steps in that direction. We know that global investors are very fixated right now on the AI theme. India does not offer too much on that. So we need to get our house in order, get earnings in order, and earnings are coming back. And these three events will further put the confidence for global investors to look at Indian market at a more reasonable valuation. Valuations and earnings are the most critical thing when people evaluate markets. And today, when you look at valuations of Indian market, they are below their last 10-year average. The India premium, the India large premium to emerging market has come down dramatically over the last 15, 17 months. It's still at a premium, but that's come down quite materially. And the three events are reinforcing that India is a long-term story with the short-term headwinds abating as we speak. The U.S. tariff deal, in our view, was the biggest irritant for global investors. We still await the details which are going to come out from the deal, but it's a very important step in the right direction for investor confidence to come back in India.
But based on what you were saying there, Nitin, am I corrected to understand that in terms of order of importance right now, it's earnings and this AI exposure or lack thereof that might be more important for where markets head in India versus some clarity on the trade deal?
No. Trade deal was very, very, very important. It was the biggest worry for a lot of investors. India was one of the very, very few countries who hadn't had a trade deal, and that leaves a lot of uncertainty for investors on an ongoing basis. Rupee was also getting impacted because foreign investors were not investing into India. There are multiple reasons why they're not investing in India. Rupee was also getting impacted. So the trade deal was very, very, very important. But ultimately, after the trade deal, you need to get earnings and valuation on your side. And that's what I was saying, that we need to get earnings back up, and earnings are coming back as we speak.
Okay, so before we get into the earnings, and just one more question on the trade deal, I'm sure you've taken a cursory glance at what's been covered and what's been agreed upon. Yes. Are there any particular sectors that investors should look out for from this trade deal that might get some upside, whether it be big or small?
I think, so overnight in the US, the software and SaaS systems have taken a big knock, but otherwise, the trade deal takes away a lot of uncertainty over the issues of H-1B visa. So the tech sector could have benefited from reduced uncertainty on visa issues directly because after the trade deal was signed. Of course, the heavy employment sectors like textiles, small machineries, and even gems and jewelry would have taken a big step positive because of the trade deal. The uncertainty on those businesses were very high. Broadly speaking, those are sectors which were getting a positive impact immediately from the trade deal. Others, there is obviously the big play that India is looking at, China +1. Now, interestingly, this is not the first of the trade deal. It is the 20+ trade deal that India has signed. India has recently signed with EU, as we earlier discussed. Now, with these trade deals in a pocket, or we don't have the final details yet, but India could actually be in the pivotal role in a pole position for China +1 opportunity in manufacturing too. So that's going to be a longer drawn outlook, but that was completely done away with. People are not talking about China +1 in India. Suddenly that is back on the table. Okay.
Since we were talking about earnings, let's get into it because we are about to get into the thick of earnings season out in India. The argument last year as to why Indian markets were not as badly hit as expected was because the Indian government and India itself was able to successfully pivot towards stimulating the domestic economy via those GST reforms and all of that. Do you think this is going to be the more important determinant for earnings season and the outlook from folks like Kotak Mahindra when we're looking at Indian earnings right now, that it's going to be still how strong domestic consumption contributes to earnings in the years to come?
So, when you think about it long term, why does India attract global investors, and why was India a key overweight market for global investors? Because India's earnings were secular. India's earnings were higher than the rest of the emerging markets. And for the last post-COVID, India did a very great job in demonstrating that India's earnings were significantly better than other emerging markets. But we faltered in the last 18 months odd, where other emerging markets came back, maybe driven by AI theme, but they were better than India on earnings. And now the earnings have to come back. We had a year where the earnings were struggling. Possibly also nominal GDP growth was also below expectations, or it was all-time low nominal GDP growth last year, and that's coming back up. And now we're seeing a lot of tailwinds in earnings, banking in particular. There's a lot of tailwinds in consumption. As you said, GST-related cuts will boost some consumption. Obviously, we have to look at how profitability moves up. Demand is moving up a bit, but it's still a little bit of first start. Then you have to look at the numbers. Numbers are looking okay. They're not looking bad, and the outlook of numbers look reasonably strong over the next 2 years.
Okay, so since you mentioned financials a while ago, I want to get your outlook on this because some analysts out there have also posited that maybe the recent budget that was passed might not have been favorable to either brokerages or non-bank financials at the moment. How is the budget and all of these developments now influencing, perhaps shaping your outlook on financials? Is this a sector that we're going to have to perhaps look at cautiously as we head into earnings season?
I think the earnings season for most big banks, the numbers have already been out. The numbers are reasonably okay. The outlook from that perspective, from the budgeting perspective, there are two irritants in our view. One, obviously, is that the gross borrowing for the budget has been higher than what the market was expecting. That possibly leads to a hardening of yields. That can lead to a little bit of liability-related cost issues for the banking sector, but I think that's something which is very marginal. It's not a big problem for the banking system. The other one, as you mentioned, is on the brokerages, another, which is the securities transaction tax, which has been increased. I think it was it is an irritant. It is a big irritant for people, especially who are high-frequency traders. There was that worry on speculative activity in India being very, very high. So to curb that, they did it. But all in all, it was a negative outcome for the industry as we speak. But when you look at the outcomes, these are issues which can be mitigated, and these are not structural issues. These are a little bit of issues which are short-term irritants. I think, so from that perspective, I'm not too worried about it. We have a monetary policy also scheduled this week. The RBI is going to come out with monetary policy. Our view going into the monetary policy maybe a month back was that there could be a cut. Now we think that possibly it's a toss-up between a status quo or a cut. So I think the rate cycle from an asset perspective, which was pretty negative last year when the central bank was cutting rates, is now at the end, and we are in a long pause. And from a liability perspective, the repricing is still underway. So from banking sector perspective, this minor irritant of hardening of yield because of the budget-related outcome is just a minor irritant. It's not going to be a big headwind for the sector as a whole.
So if I take into account the earnings outlook based on some of the secular drivers in India, you talk about the trade deal, you talk about the budget. Again, there's a lot actually. What other sectors should investors watch out for better or worse, Nitin?
I think the one sector which gets negatively impacted by trade deals is autos, or to some extent, because you open up your market for global competition. One has to be careful about how much of auto sector can get a hit by global competition coming into India. Indian companies are very, very agile, but one that has to be looked upon from a negative watch perspective. From a positive watch perspective, I think sectors like textiles, obviously we had a big rally yesterday, but it's not well represented in the market. It's a small segment within the market, but they had a big leg up. Chemicals could be an interesting sector. We have had rupee depreciation. We talked about rupee depreciation, a record low of 92 that we had a print. Now, on a relative basis, Indian rupee is sharply depreciated against major currencies in the last couple of years. And that could lead to some export segments like chemicals coming back into the in earnings. So I think there are some pockets where there is uplift in earning. As I was saying that the irritant on H1B was looking to go away, but overnight the software sector has taken a big hit. So we'll have to look at how the earnings play out in the near term versus the sentiment, which is negative as we speak. So there's a toss-up between that. But otherwise, earnings are more domestic-driven than linked to any trade deal in the near term. In the longer term, as India gets plugged into China plus one opportunity, or starts exporting or getting in the middle of things, there could be longer term opportunities from this trade deals.
But just very, very quickly here, Nitin, could that rupee weakness also serve as a dampener for earnings, because it could impact potentially earnings confidence, consumer confidence down the road, and thus also feed into earnings later on? Is that something we have to be concerned about, or are you not seeing signs of that yet?
Actually, when you think about the maths, rupee depreciation actually leads to a little bit of earnings uptick.
Okay.
Because there are a lot of sectors like tech, pharma, global exporters, which get a tailwind from rupee depreciation to some extent. Net to net, it's not a big headwind, unless it feeds into inflation in a big way. And if you look at inflation numbers in India, they have been pretty moderate. It has been around 1% odd, far lower than the central bank target of 4%. In some ways, that has not fed into a negative outcome. But what it does on rupee depreciation, to our view, is a longer-term damage on capital flows. And that is where the problem lies, that global investors have not put money to work in India for the last 5 years. They are underweight India, and we need to incentivize them. In some way, this budget also was a missed opportunity in our view, because global investors are taxed in India. That remains a big irritant for them. For as we speak, the rupee depreciation should not become a further headwind for global investors to look at India positively. That's the only big irritant as we speak. Otherwise, it does not have a negative impact on earnings. And as long as inflation is managed, it is not feeding into a consumption-related stress in India.
Okay, I stand corrected on the rupee's possible impact, negative impact on those earnings. Nitin Jain, thank you so much for joining us today and outlining how all of this will shape the outlook now and perhaps influence the direction for Indian markets after a busy last couple of days on the macro front for India. That's Nitin Jain from Kotak Mahindra Asset Management. Meantime, gold is also coming back quite strongly after those sharp falls we saw earlier this week and bouncing back above $5,000. And they're also building on a near 6% rally from Tuesday. That was its best day, actually, since 2008. Right now, you're seeing it at $5,039 per troy ounce, up about 2% intraday. Goldman Sachs is now saying it still sees significant upside to its $5,400 gold forecast for this year. Our Dan Murphy spoke to Bridgewater founder Ray Dalio at the World Government Summit, with the veteran investor telling him that he believes gold is the safest money. Take a listen.
Gold is the second largest reserve currencies. I think if people were to make those who are running policies and so on were to say, they would say gold is the safest money in this kind of an environment.
Still the safest.
Yeah, it doesn't change by the day. You know, gold is up about 65% from a year ago, and down about 16% from its high. And I think people make the mistake of thinking, is it going to go up and down, and should I buy it? And instead, not whether it's individuals, but even more importantly, perhaps central banks or governments or sovereign wealth funds should say, what percentage of my financial assets, what percentage of my portfolio should I have in gold? And think about that percentage. And then if the price goes up and down, if it goes up too much, you sell out to get back to that number, it goes down too much. But to keep a certain percentage, because it's a very effective diversifier to other parts of the portfolio. I think that it's best to say, if you didn't know what markets were going to do, what should my allocation be to different markets? And because gold is a diversifier, in other words, when the bad times come along, it does uniquely well, and when the good times are prosperous, it less so. It's an effective diversifier. So I would say that perspective. I'd say the most important thing is to have a well-diversified portfolio. So I'm not saying run out and buy gold and hot because the market's going to be hot, but more to think strategically about what is the right mix of assets to own, whether you are an individual or a central bank or a country or a sovereign wealth fund.
Time for a quick cup of coffee, but don't go away. Inside India, we'll be back in about 2 minutes. Welcome back to Inside India. Venezuela's envoy to Beijing is reassuring China that its energy, trade, and investments are safe, a month after the U.S. attacked the South American country. Our China reporter Elaine Yu has the details. Elaine, what else did the Venezuelan envoy tell the folks out in Beijing with regards to the status of their own investments in their country?
Yeah, the ambassador was speaking to reporters in Beijing, and he said China and Venezuela are trusted partners and that their bilateral relationship shall remain unaffected by interference by other countries. And he also said that Chinese companies operating in Venezuela and investments from other nations will continue to progress normally. And this applies, he said, not only to the petroleum sector, but also all areas of cooperation with Venezuela. And indeed, China has a range of investments in the country, from oil fields to telecoms network to power grids and satellite tracking systems. And for years, China has been Venezuela's top oil buyer, with these shipments helping Venezuela repay these huge loans to Beijing in these so-called debt for oil deals. But the ambassador also dismissed suggestions that the U.S. could set prices for oil transactions between China and Venezuela. And earlier, the Trump administration has suggested that China could buy these oil, but not at, quote, unfair or undercutting prices. The ambassador Ceballos said that regarding oil pricing, Venezuela will not heed the agreements or arrangements of the U.S. or other countries, and that they have the right to make independent decisions determined based on global market prices. And the U.S. is reportedly working on issuing general licenses for oil and gas production in Venezuela, according to Reuters. And the timing of all this is very significant as well. We have the first South American leader, the Uruguay president, currently in China for a week-long state visit. And Xi Jinping said they should promote a multilateral world order, and that China supports Uruguay in chairing the G77 plus China, which is a coalition that includes India. So we see both China and the U.S. sort of working to extend their ties and influence in the region with different various Latin American countries. JP?
Yeah, Elaine, thank you so much for those very important updates with regards to China and in the U.S. in light of what's happened in Venezuela. Still ahead, what does the long-awaited India-U.S. trade deal agreement actually mean for the ties of both countries? We will be speaking with Evan Feigenbaum from Carnegie Endowment for International Peace right after this break. Don't go away. Welcome back to Inside India. We are counting down to the market open out in India, and this is how we're shaping up a final check of what GIFT Nifty futures are forecasting, perhaps a 50-point increase, that is, for the Nifty 50 when they resume trading later on. Again, flat to the upside is what it's what's indicating, perhaps just signs that there's still a little bit more caution out in Mumbai with regards to how markets should regard the flurry of developments in the last couple of days from the US-India trade deal and also the announcement of India's budget just a few days ago. The rupee also looking just a bit softer against the greenback at 90.43 against the US dollar. Well, let's dive a little deeper into the contours of the India-US trade deal. Not much in terms of details out yet, but Washington, D.C. has made it very clear that New Delhi will stop buying Russian oil and explore other avenues. This was a key demand from the United States, one that President Trump had reiterated time and again since imposing that additional penalty of 25% on India for those purchases. Well, we've not heard any further details on this from the Indian side yet. Take a listen again to what U.S. Trade Representative Jameson Greer told our colleagues overnight.
So remember, India, prior to 2022-2023, really didn't import Russian crude. They took advantage of a situation where Russian crude was trading at a discount because they couldn't get it to any other countries because of sanctions. President Trump very accurately put the Indians on notice that we viewed this as supporting the Russian war effort. And starting early, at the end of last year, the Indians started winding down their purchase of Russian oil. We've been monitoring that. They've been diversifying purchases of energy from the U.S., not just oil, but also gas, propane, other things. That's been going up. We'll keep monitoring that. Obviously, they want to diversify from other sources too, whether it's Venezuela or the Gulf, etc. There are a lot of opportunities to do this. The Indians are making the right choice.
So was this really all about Russian oil purchases? Well, maybe there's more to it than meets the eye. Evan Feigenbaum is Vice President for Studies in the Asia Pacific at the Carnegie Endowment for International Peace. He was the U.S. Deputy Assistant Secretary of State handling U.S.-India relations under President George W. Bush. Evan, thank you so much for joining us today. You heard what U.S. Trade Representative Jameson Greer had to say about Russian oil purchases and why it was important. Was it really down to India just weaning themselves off those Russian crude oil imports and perhaps directing it to the United States in order to clinch this trade deal? Or do you think there's more than meets the eye there?
I think there's a lot going on, and I think it's notable that the American side is doing most of the talking, and the Indian side isn't digging very much into the details, which suggests to me that there's a lot that still has to be worked out, and this is more of a framework agreement. It's good news because the situation between the United States and India, as it was utterly unsustainable. This is a relationship that a lot of people, as you said, myself included, put a lot of work into over 25 years. And so having the floor completely fall out of the relationship, which it had, was a catastrophe and really not sustainable. But I think there's a contrast between, for example, the free trade agreement that the European Union did just about a week ago with India, that's been under negotiation for over a decade, and is, as the title implies, a free trade agreement. And this thing with the Americans, which is really a deal, the operative word being deal. The United States hasn't done fully blown free trade agreements bilaterally or plurilaterally in the way that we conventionally understand them since somewhere between the Triassic and the Jurassic era. And so the difference is pretty notable. On the one hand, this is more flexible, but it also means that because it's flexible, the president of the United States can change his mind, layer in other issues. And we've seen that movie, not just with India, but with South Korea, Canada, and others. And that's a cautionary.
So let's touch on that as well, because as you mentioned, this is just an announcement that there was a deal that's been struck. As we know, getting a formal document out there might take months even before we actually see a sign off and perhaps all the implications in the trade deal implemented. Again, because the U.S. president has shown that he can change his mind and perhaps throw new tariff declarations, does this give us an idea that this is how countries dealing with the United States have to approach it now, knowing that these framework deals are just a lot of things that are a lot of headlines and with scant detail to follow, and thus also just gives countries an idea of how to approach the United States under this new normal, if I can call it that.
Well, it's hard to know how to approach the United States because, to be candid about it, the president is highly transactional, and the collateral damage of the period, particularly since August, when the United States layered the additional 25% penalty tied to Russian oil purchases onto the 25% base tariff, is that there's been a complete collapse of trust among a large number of people in India, including those who are invested in the relationship over time. The headline story in the United States is ostensibly the Russian oil purchases. The headline story in India is really the tariff rate. 18% is better than 50%, but it should never have been 50% in the first place. And trying to coerce India publicly in a somewhat humiliating way on Russia really added insult to injury. The problem I see, and I'll just be blunt about it, is the President of the United States just loves tariffs, full stop. And he sees them as an almost one-size-fits-all tool that he can apply to almost any issue that he's seized of at any given moment. You will know, as do your viewers, that he has threatened to impose them because people object, that he wants to annex Greenland. He's threatened to impose them because he doesn't like that you've joined the BRICS group in your foreign policy. He's threatened Canada with additional tariffs after having previously supposedly reached an agreement because he's upset that Mark Carney went to China. He's tried to impose them over counter narcotics and fentanyl flow. So the problem we have is that the president is like alternate side of the street parking in New York City. And so the challenge India has is to try to lock this in while trying to cut down some of that American space to be overly transactional. The other thing I'd say is tariff rates don't elide every other element of competitive advantage. And so while it's true that India's 18% is better than, say, 19% for most of ASEAN or 20% for Vietnam before you layer on the Chinese transshipment, that's not the only part of the story that makes East Asian countries competitively well positioned. The Vietnam story isn't just about tariff rates, and the China story was never just about cost. So India has to not drop the ball on some of the other things that would make it attractive as well.
Evan, we talked about how much time it took for diplomats like yourselves to build those strong U.S.-India relations that seem to have been scarred somewhat by these. And you've also mentioned that perhaps the deeper implications here are really that the relations between the U.S. and India might carry some scars moving forward, despite this seeming agreement. Are there more serious implications, not just for India and the U.S., but also for geopolitical security with regards to this seeming souring of relations that under the surface might be a bit harder to repair, as some might be implying?
Well, I think a lot of American allies, particularly in the Asia-Pacific region, found the American posture toward India extremely puzzling. I mean, they've all been on the receiving end of President Trump's tariff threats, sometimes his tariff implementation. But nonetheless, if you're sitting in, let's say, Tokyo or in Canberra, Australia, or in some of the traditional American defense partners around the region, and you're worried about deterring China and you want to build some kind of a geostrategic coalition to at least shape the strategic environment which China confronts, India is at least a part of that broad balance in the region because it's a large continental-sized country, the rise of which many people in the region thought would be existentially useful for the balance of power. So I've had a lot of conversations with Japanese, with Australians, and people who are just utterly puzzled by the U.S. posture. I think the collateral with India is twofold, and this won't be easy to rebuild just because you lower a tariff rate. One is that their signature achievement on both sides, and it was really a bipartisan achievement, both Republicans and Democrats, people on all political sides in India and different administrations, was to get the politics out of it. This had once been a highly politicized relationship, and it became increasingly depoliticized where a lot of people were invested in it. Putting Prime Minister Modi on the back foot, energizing the opposition, the public, the media, that wasn't productive, and it's repoliticized this thing in India in a way that's very unproductive. The other thing is the Russian oil tariff. We have always, in the U.S.-India relationship, had objections to one another's relations with third parties. The United States never liked their relationship with Iran, for example. They didn't like ours with Pakistan. But we've been very careful about not letting it bleed back into the bilateral. So imposing this Russian tariff, it was absolutely a fool's errand to think that you could coerce India into that. The Russia relationship is sentimental, but it's also part of Indian strategic autonomy. And it became caught up in domestic politics. So that's the collateral I worry about. And I don't think the trust will be easy to rebuild. But this is a start.
Could perhaps the trust perhaps be stabilized in some ways based on the next round of discussions that India and the U.S. are looking at, and that's the critical minerals deal that both sides are trying to ink? I know the United States wants to secure more critical and rare earth minerals. There has been talk about India having among the 5 biggest reserves of rare earths in the world, but they're having difficulty at least mobilizing those. Again, is this perhaps an avenue where they can perhaps rebuild certain ties, or is this perhaps is there more that needs to be done?
Well, there's a lot more that needs to be done, but that has a lot to do with industry dynamics. So I think there's the signaling issue, and then there's the substantive issue and its impact on markets and on supply chains. Both sides are signaling very hard. The Indian External Affairs Minister, Mr. Jaishankar, was in Washington today. He met with the Secretary of State, with the Secretary of the Treasury. Critical minerals was part of that discussion. And the Trump administration has an initiative called Pax Silica that's designed to reinforce and build let's say China-proof some of these critical mineral supply chains. Having India in that, I think from a geopolitical and a political signaling perspective is a good thing, and both sides are embracing it. China dominates this industry, not just because of supply and mining, of course, but because of processing. And so there are a lot of questions that have to be worked through at the industry level in terms of where India fits into that story, in which segments of the industry, in which parts of the supply chain, and something has to be done about the processing questions, not just the mining questions. So there's a lot of work to be done.
Evan, just before we let you go, I did want to get your thoughts and comments on this. We're getting some news from the Financial Times right now that the latest AI chip sales from NVIDIA to China have been stalled by yet another U.S. security review. Now, some might say, well, surprise, surprise, I feel like I've seen this episode of Seinfeld before. But any thoughts on these recent developments and what this will also mean, not just in terms of tech security, but also with regards to trade relations now?
Sure. It's of a piece with the broad trajectory of the U.S.-China relationship over the last decade or so. You mentioned I've done a lot of work on U.S.-India relations. I've been working on China actually for even longer, about 35 or 40 years, including in the government and out of the government. And what's really striking over the last decade or so is what I would call the securitization of almost everything: flows of capital, flows of people, of technology, of data. These things are not just commercial or market questions anymore. Increasingly, economics and security have collapsed together. And technology is particularly vulnerable to this securitization because so many technologies are inherently dual or multiple use, and so they have defense implications, even when they have commercial implications. So the broad trajectory since basically late Obama into Trump 1 through Biden was to securitize these things. That shows how some of the export control carve-outs that China had managed to win, not least around NVIDIA-related technology, was a bit of an exception to the rule. And it says something about where President Trump's head is personally and how much it diverges from that trajectory. What I would say, though, is the Chinese have learned something important, which is that if they flood the zone with enough export control requests, the president and some others in the administration have showed enough ankle that it suggests that even if they can't roll back this trajectory, they can get case-by-case exceptions. And it may not apply to all sets of chips, but in a lot of other areas, life sciences, engineering systems, data, they may feel that the last round with NVIDIA showed that the administration has some ankle to show, and that may nonetheless suggest there could be some divergence from this.
All right. Evan Feigenbaum from the Carnegie Endowment for International Peace. Thank you so much for joining us today. I know it's late out there stateside, but we appreciate you taking some time out to talk to us about about all the recent developments in India and also this recent development with NVIDIA and their chip sales to China as well. We're counting down to the market open in Mumbai now, and we'll be back in 2 minutes. Once that cracks, we're going to show you the early movers and shakers when the market operations, at least in India, resume later on. We're back in 2 minutes. 54 seconds into the Indian market open, and it's looking fairly red actually for the Nifty 50 and softening and just trading about 0.25% in the red, down to about 25,666. We're looking at the rupee looking quite soft today at about 90.49 against the US dollar, and just continuing that weakening trend for the local currency we've observed over the last couple of months. So a quick check now on some of the Indian IT majors after the tech sell-off we saw in the U.S. overnight, and software stocks looking soft out in the U.S. And that seems to be the case also for many of these other IT services providers. Take a look at Wipro now falling and plunging by about 5.2%, but not as bad as Infosys, which is down by about 5.8%. Similar outlooks, that is, for the likes of TCS and Nifty and the broad-based Nifty IT. They're all down, but perhaps also heavy for HCL Tech, which is trading about 6% lower. Pivoting to the aviation sector now, in shares of Adani Enterprises now trending up by about 0.9%. It's a meager increase right now for Adani Enterprises. But again, we'll take it given the broad market, the cautious sentiment we're seeing across the broader markets. Italy's defense company Leonardo and India's Adani Defense and Aerospace have signed an agreement now to build a helicopter manufacturing base out in India. Adani says that the objective is to meet the growing needs of the Indian military, and the project could later expand to civil aviation as well. The group also says that it expects Indian armed forces to require more than 1,000 helicopters over the next 10 years. Now, speaking of the Adani Group, let's head back to the 2026 Singapore Air Show, where our travel and transport reporter Monica Petrelli is standing by live. Monica, there was another deal inked apparently between Adani Aerospace and Embraer recently, but we understand you've got more info on that.
Yeah, hi, JP. Yeah, we learned about that agreement before the air show. In fact, last week, this agreement, which is being called a landmark agreement between Embraer and Adani Defense and Aerospace, would be a first for Embraer, because it includes details that say that there would be final assembly of Embraer's E-2 jets inside of India. Now, this would be the first time Embraer makes these jets outside of its home country of Brazil. Now, this also would be a big step for India in its quest for a more self-reliant country. Now, we do know having and making your own aircraft inside your country not only supplies jobs, but it also brings that clout on the international stage, which India is now currently seeking. Now, we did have a chance to talk with Embraer. We sat down with Arian Mayor. He's the president and CEO of Embraer's commercial aviation unit. And here's what he had to say about the company's push into the subcontinent.
India is the third largest country in the world, and we have 50 aircraft flying around in the country, which is a relatively low number compared to the amount of people and the size of the country. And we believe that Adani is a partner in commercial aviation space that complements Embraer perfectly. So one of the options is building aircraft in India as a Make in India initiative for the Indian market, which is a huge market that we see ahead of us of around 500 aircraft in the next 20 years.
Now, that was Arian Mayor with Embraer here. But of course, that's not the only company that's in prime position to really capture India's growth story in the aviation market. We know another company also seeking here is ATR. Now, this company, a joint venture between Airbus and Leonardo, established back in 1981, and it makes turboprops, not jets. Now, turboprop planes, they're slower, but they're more fuel efficient, which means they cost less to fly, which you can pass on those savings to the passengers. Now, speaking with us here today, we have ATR CEO, Nathalie Tamodlod. Welcome to the program.
Thank you very much. Thank you very much.
So, I want to talk about your push into the India market. Now, we do know incredible potential, especially for the regional domestic market. Turboprop planes are best flown maybe under 3 hours. We also know India is a very price-sensitive market. So what are you doing to make inroads into India's regional aviation?
Thank you very much. In India, we are already very present because we have 70 aircraft being operated now in India. And of course, we have a lot of hope to continue to grow. When we look at the market in India, for us, it's a big market going forward, where we assess about 210 aircraft being on order in the next 20 years. And we believe we have a very good chance because our aircraft is the most suitable for those routes in India, which are lower than 400 nautical miles and where efficiency is needed. And we have the most competitive aircraft in this category, below 400 nautical miles. We did a study recently and we looked at the movements of people in India. Out of 4.6 billion of movements, there is only 3% of movements which are done by plane, which means that there is a big potential to increase the acquisition of customers via plane and bring people into planes. And we believe we have the suitable aircraft for that.
And are you talking to any of the big aviation players there? You know, there were reports that Indigo had placed an order for ATR planes, but we never heard of any confirmation of that.
I think we already have a good number of aircraft being operated by Indigo. And so far we understand they are very happy with the aircraft. Of course, we are talking to a number of people, but I cannot disclose the names of those people because those discussions are very confidential, as you can imagine. But we are talking to a number of people in India. And we want to be working with them to support them in making their decisions.
And so, you know, we just heard Embraer now signing an MOU to possibly assemble some of its aircraft inside of India. Would ATR consider doing anything like that in order to crack open that door a little bit wider into the marketplace?
We are ready to look at opportunities in India. So we are working closely with the operators, we are working closely with the authorities, and of course we will work towards a solution which will help us bring forward more aircraft in India. This is really one of the key targets for ATR, really.
So would you be able to estimate, say you had a 2-hour domestic flight inside of India, if you took a jet versus a turboprop, how much savings are we talking about here?
I think we are looking at routes which are sometimes lower than 2 hours of flight. So most of the routes are below 1 hour of flight. And we look at the savings, it's a minus 45% savings on a trip basis versus a jet, and minus 30% in terms of per seat savings. So it's a real saving that the operators will make with using the ATR. And again, you mentioned the sensitivity to price in this region, and I think we have the right solution for answering that need to travel more at the least cost, and ATR is the perfect platform for that.
And, you know, we also see the company making some inroads in other parts of Asia Pacific. Here at this show, the company announcing an agreement with Air Borneo, which is a company that's just starting operations as of last month. How important is this to the company?
For us, it's a very important order. We've been working very closely between the teams to achieve it, and we are very happy that we could announce it yesterday. So it's a very good news for us. And of course, we hope for more in this region. Overall, if we look at Asia Pacific, it's our #1 market. We have currently 500 aircraft flying out of the 1,300 aircraft that we have operating worldwide. It's a major market. And if we look at the future, this is becoming even an increased number, because when we look at our perspective, it's 1,000 aircraft in this region, Asia Pacific, out of the 2,100 that we are targeting. So you can see the importance of this region for us. I mean, we are already very well placed, being the regional aircraft manufacturer, which is the better place, but we want to continue in that direction. And this will be done via two things: replacement of existing aircraft. This is what we did notably with Uniair at the beginning of the year, where we announced a 19 aircraft deal. But and Bangkok Airways last year as well was the same. But on top of that, we want to support the growth in some regions. And the growth is in India, the growth is in Korea, the growth is a lot in this region. So we are very happy about that.
Nathalie, thank you so much for taking the time to speak with us today. This is Nathalie Tamodmod. She is CEO of ATR. And here, that's a wrap for us at the Singapore Air Show. It's back to you in the studio, JP.
An exciting place to be at the Singapore Air Show, indeed, and the hint of jealousy, at least from my end, that you're out there seeing all the developments. Monica Petrelli, thank you so much for joining us and bringing us that very interesting conversation. Well, that's all the time we have today on Inside India, but do keep watching CNBC. That's because Access Middle East is coming up next. Have a good morning.